it. The difference between bond price and yield, Katie. This is one I know. We've both talked about this several times in our trading careers, but it's a huge sticking point for people at home. You hear about all the interest rate talk. The Fed is doing yada, yada. Inflation is X, Y, Z. I want to get into interest rates. And then you bombard me with this difference between bond prices and yields. Like, everybody loves stocks because it's like, oh, Apple's releasing a new iPhone. If I think Apple is sick, I buy it. If I think they're not sick, I sell it. Very, very easy. Interest rates, it should be the same thing, right? Like, the Fed is doing whatever. I think that rates are going up, or I think that they're going down. I should be able to buy or sell it. Not the case, at least with traditional markets, because you got that bond price, right?
Exactly. It's just like another barrier to entry. And even, having learned with Pete and just been trading for so many years now, that is still the asset class where I just like black out when somebody starts to talk about inverse relationships and a couple of the things that we're going to talk about today. But it's important to talk about them to reduce and eliminate those barriers so that we can actually participate in the markets, because there's a lot of interesting opportunities out there, especially right now, as you said.
100%. And hopefully where we're going to arrive at, hopefully everybody finds this interesting and you kind of get your fill of what you're looking for in the difference between bond prices and yields. And we have some really cool, at least I think they're cool, numbers to make you feel more comfortable in this space. But at the end of the day, the small exchange has truly, this is one of the things we're most proud of, is we've revolutionized interest rates. And I don't use that word lightly. I'm not one of these people who is like, oh, we're disruptors and whatever. But like, interest rates have been so hard to trade. This is coming from a guy who came out of college trading interest rates. That's all I did at the Board of Trade. They're so hard to get started trading. And the small exchange has literally created products that are as small as you can get. And they just trade in yield, or that is the interest rate. If you think rates are going higher, you buy it. If you think they're going lower, you sell it. So we'll arrive at a simplified version of it. But I do want to do some of the background math for people, because a lot of the people do like some of the traditional products, or they at least want some reference points in treasury notes and treasury bonds and how they're priced relative to the yields. But let's kick it off with just, I think, what a lot of people are probably seeing in their Twitter feeds and elsewhere. And that's treasury yields. They're popping off, Katie. They're multi-year highs. And we're looking at the short-term yield up hundreds of percentage points in terms of price action, but up to 1% in terms of the yield.
Yeah, exactly. I mean, this chart explains it all. And I think that, the second chart helps drive home the first point and the whole crux of this conversation of those bond prices compared to this yield. But yeah, as you can see, multi-year price extreme, partially driven by what we're kind of hearing about a lot in the news headlines.
Yeah. So this is the big news item, probably why a lot of you are coming to these markets, because you're seeing, oh, wow, inflation's pace is faster than we thought, and the Fed is going to have to hike aggressively and everything else. And this is being reflected in just the way that you would think, right? Like, if I'm at Wall Street Journal or wherever, I'm just on Twitter, and I see headline that says like interest rates at multi-year highs or highest they've been since the start of the pandemic, I would love to then just go right to a chart in my platform and buy or sell that interest rate. And right here, you have that in S2Y. But story aside, let's start doing some of the number crunching, because for a rise in yields, Katie, you have a fall in the corresponding notes price, correct?
Correct. Yeah. So this is perfect because we're comparing 2-year to 2-year. We're not talking about different durations here. We'll get into further durations here and how, changes in short term kind of trickle down to the longer end of the curve. But yeah, exactly. Inverse relationship, overlaying those two on top of each other. And you've got like a complete, I don't even know what to call it. There you go.
This is I would say this is, I forget the term when I was studying piano, but like the idea is in music, you go off on an adventure, especially in like improv jazz and everything else. You're blasting off right throughout the song. You're in boop-a-doo, boop-a-doo, but then where you end, Katie, is where all the notes kind of converge, and it's like, oh, you get that feeling of relief when the song ends. It's like, oh, we're back at home. This is where it concludes. And this is the charts laid on top of each other. You can see that they're direct mirror images here. You're like, oh, yields are up big. Wow, craziness. Notes are down big. What does this all mean? They're direct reflections of each other. A lot of people will ask, well, if yields are rising, what's happening to notes? Like there's no A to B in this scenario. It's just A. One thing happens and they both move directly. There's no lagging or anything like that. It's just a matter of, for yields rising, how much do the notes or bonds fall in price and vice versa, right? That's kind of the big conversation.
It's like a nearly perfect negative correlation.
Exactly right. Which is to say, like, unless you're using one to hedge the other, there's almost no case for pairs trading, right? Like I think a lot of people would be like, oh, well, if I see 2-year yields rally and the 2-year notes stay flat, then I can sell the 2-year yields and I can also sell the 2-year notes because they happen in the exact microsecond as each other. There's no A to B. It is just for hedging purposes. You would trade one against the other.
Exactly. Yeah. You're canceling each other out.
And so with that in mind, I want to not look at some hedging trades, but just look at these compared to each other. And I have to do it, everybody. I have to bring up basis points. I have to throw this BP in front of you. If you ever see the BP or the big BP and then a small S next to it like that, we're talking basis points here. And a basis point in interest rates, in yields, in everything is 0.01. And so if 2-year yields rise 1 basis point, that is going from, let's just call it 1.00% to 1.01%. Are we good on basis points?
Yes. I seriously love like talking like this. So keep like continuing to do it in this style, because I think it's really easy to then like watch this over and over again to help people digest.
We try to lack pretension here on this program as much as we can. I'm not going to start flying around. Oh, bips. It's this many bips and bypass everybody. We just want to understand this stuff so we can trade it and we can hopefully make some money. And you can see here that the dollar value of a basis point is just it sounds like a big phrase, but it is just literally the amount of US dollars that goes in or out of a given product relative to a basis point increase or fall. Very straightforward in the yield products because they're priced in yield. And so if that basis point rise happens, it's reflected directly by just $10 in 2 years, $10 in 10 years, $10 in 30 years. Very simple. And you can see it in the products. If you let me go back to the chart here of that 2-year, $10 even, 10.00 is 1% in 2-year yields. It's just a multiplier. We had to make push that decimal point one place over. Mm-hmm. And so, Katie, to get 1 basis point higher in S2Y, let's say it's at $10, which is 1% even, a rise up to 1.01% would be a change from $10.00 to $10.10. It seems kind of wonky, but just think of it 1.01%, 10.10 in terms of the price. And that reflects just $10 change in the futures. Are we kind of in a comfortable place with the dollar value of a basis point in the small yield products?
So far, yes. Carry on.
I will carry on because it's only going to get a little bit more confusing, but I'm going to confuse you. And then we're going to get back to, like we talked about in jazz, a very comfortable home place where you're hopefully, it's like, oh, wow, I learned some things on the way. That was a really crazy tenor sax solo that Katie put out there a couple minutes into the song, but we're going to arrive back at a very comfortable place. The dollar value of a basis point in traditional Treasury products, ZT, ZN, and ZB being the 3 products that are here in the price section, they change. First of all, they're dynamic. And so every moment they're changing. I rounded them off for you here, and you can see they're different from each other, which is frustrating. And that's why you have ratios. You and I, Katie, remember trading the knob spread, which is 10 years to 30 years. And the reason why you do 2 or 3 10 years to 1 30 year is because for every basis point change, they change by different amounts. When it comes to the small yield products, since they have the same dollar value of a basis points, everything's 1-to-1. Everything's in the same universe. And it's very, in my mind at least, simple to trade. Everything's different in these traditional futures. And for a basis point rise in 2 years, you'll see that note future change by $40. For a basis point rise in 10 years, you'll see the notional change in the 10-year futures by $80. You'll see that change. And basis point rise in 30 years, $180 change in those futures. Are you there with me, or do we want to stop here for a second?
This makes sense. So top line is like small 2-year yield treasury products. Bottom line is the more traditional major treasury products. As far as the bottom line goes under price, as you said, those numbers are ever changing. You can go on, I'm sure like the UStreasury.gov website or whatever probably has those DVO ones and calculated them minute by minute for those fluctuations, but super helpful that you just kind of rounded them and generalized them for this conversation.
Since I've done this a million times, I can tell you exactly what you need to Google. You need to Google CME Treasury Analytics, and then you'll get to a page that'll have the futures DVO ones. That's what you're looking for there. But we must press on because we're running out of time. Actually, we already ran out of time, but Pete Momat is a very kind man, and so he'll wait for us here. So just one quick example. If we saw a percentage point rise from where we're at right now in 2 years, 10 years, and 30-year yields, if 2-year yields right now are at 1% and they rose up to 2%, you would, in the 2-year yield futures, you just see a $10 change in the futures price. Same with the 10 years, same with the 30 years. In the prices, remember, they move inversely and they have different DVO ones. And so the notes in the 2 years will drop by 2 points. In the 10 years, they'll drop by 8 points. In the 30 years, they'll drop by 18 points. And thus, we get home here with the idea of, if you think short-term rates are going to 2%, or inversely, you think they're going to zero, you can see that change in S2Y from $10 up to $20 or $10 down to zero. In ZT, they'll go from a price right now about 108 apostrophe 16. And that's, I don't even want to get into that right now, but essentially 108 half is where 2-year futures are at right now. For a percentage point rise, you'll see ZT come down to 106 and a half. For a percentage point fall, you'll see ZT go up to 110 and a half. And if you think rates are going higher, friends, you can buy S2Y or you can sell ZT. I laid it all out there for you. Of course, I'm biased here at the small exchange, but also I think at home, you're hopefully thinking it's easier to just buy that yield if I think rates are going higher, or sell it if I think they're going lower. Right? I think we got somewhere here today. Katie, what do you think?
I think you did. And I just want to drive home that point